Okay, study unit 6, capital allowances. All right, capital obviously refers to what?
Can I say assets?
Well, yes, you can.
Oh, okay, wait. Okay.
An asset would be
Uh,
considered capital because it's a long-term asset. So basically, capital is the tree rather than the fruit.
yes.
Okay, so when you're looking at capital allowances, you're looking at allowances, in other words, deductions that you can make use of that relates to the tree and not the fruit. Okay, so we've been looking at study unit 5, which is deductions and allowances from an operations point of view. So, in other words, day to day running of the business. Okay, here we're looking at the actual property, we're looking at the land, we're looking at the buildings, we're looking at the equipment, okay, the machinery, the vehicles, all of that stuff. Okay, those items have certain capital allowances that are allowable. So, why do you think government will allow capital allowances? Why do they want you to deduct in terms of the tree and not just the fruit?
Because I think it's critical to produce income. It's
Yes, and why do you want them to buy more trees?
to produce more income,
Exactly, so the
more
business can
jobs, or
grow. Right, so yeah,
there we
so
go.
capital allowances is SARS's way of saying, well, invest in property, plant, and equipment. Okay, not only invest in property, plant, and equipment because it's going to make you more efficient and you can optimize your business, you can work faster, you can produce more, etc., but you can also get a tax benefit. Does that make sense?
Yes.
Okay, so that's a reason why businesses, generally speaking, purchase capital assets every few years. Okay, and you'll see in one of the slides, I've shown you wear and tear as an allowance. Wear and tear is depreciation basically, but depreciation from a tax perspective. Does that make sense?
Yes.
Okay, so when we're looking at an enduring benefit or production of income, which one relates to capitalization? Which one relates to the capital? Enduring benefit,
Uh,
right?
I have no idea.
Can you say
Could you
that
ask the
again?
question again, please?
I didn't hear you.
Can you ask
It
the
didn't
question
sound. It
again,
sounded
please?
funny there. I didn't get your audio.
Can
Say
you
it
ask
again.
the question again?
Oh, must I ask the question again?
Can you hear me
The
now?
question was, the question was, what
Please.
relates to the capital, enduring benefit or production of income, in terms of improvements versus repairs? So, is an improvement enduring benefit or is it part of production of income?
Uh, I would say both.
An improvement would add to future benefits. So it links more to the enduring benefit. The enduring benefit is the question mark. That's what you're actually focusing on because the repair would be to continue producing income. There's no future or enduring benefits. So if I
But im
repair the vehicle,
but
a
improvements will
repair,
also but improve
huh? What were you saying?
uh what? Is it my Wi-Fi or is it your Wi-Fi?
Let me check here. Can you say what you were saying again? Normally, I get a pop up. If my Wi Fi is a bit slow, I get a pop up on screen. You'll probably see it
Okay.
as well. It'll say, because Zoom If there's a problem with connection, Zoom actually brings up a message here, unstable connection or whatever. Yeah. So I haven't seen that message, so I don't know. Maybe it's just, I don't know. It's fine. Just start again. Are you still there?
Uh,
Okay, you are still there.
Okay, so what I was saying was, uh, an improvement will also, can you hear me?
Ooh, Cheryl, when you watch this video, you'll see it's definitely your connection. I don't know if you can hear me.
Can you hear me?
Can you move somewhere else? Move to a different room or just
No.
walk around somewhere or can you hear okay, can you hear me? Cheryl? Okay, I don't have any audio now. Your mic is on though, I see. Okay, I don't know if you can see the screen, but when you talk the mic goes up and down. Okay, now I've lost you. Okay, I see you back, but no mic yet. Can you just switch on the mic and let's see if it's working? Okay, the mic is on now. I see it.
Hello. Yes.
Okay, I can hear your voice.
Can you hear
Okay,
me? Like,
okay. So what I was saying, when looking at capital allowances, improvements versus repairs. Okay, there's a debate because what are you actually doing in terms of an improvement? If you're looking at an improvement, you are improving the tree. So you're giving the tree more capability in terms of future enduring benefits. Okay. Yes, there could be a greater production of income because of the enduring benefits. But when you're looking at improvements, improvements are capital because there is that future benefit, that enduring benefit. A repair, on the other hand, you would have to repair a machine so that the machine can continue producing income. Just because the machine is producing income and it's being repaired, that doesn't mean that those repairs are capital. Repairs are normal revenue expenditure, and that'll be section 11A as a deduction. Improvements would be anything to the tree, the machine, making it better. Okay, so in other words, adding to its enduring benefits. That's the focus. So the debate that we were having here is just looking at what is capital and what is revenue. Right? If we're focusing specifically on capitalization of expenses, the only expenses that you're allowed to, inverted commas, capitalize, in other words, add to the actual item, is if you had to do something to the tree. Okay, so let's assume if we had to do something and we built something that was part of the tree and we made this actually part of the tree. Okay, or whatever, machine, building, it makes no difference. Okay, it has to have an enduring benefit. Okay, that's what I'm saying. For example, tires. If you're buying tires for a vehicle, okay, the tires for the vehicle is revenue. It is not capital. Does that make sense?
yes.
Tires don't have any enduring benefits. Tires are used in the production of income day to day. It's operational. Okay, if I buy mags, okay, those mags would be considered enduring benefit because I can put any tire around the mag, I can still have those things. Okay, there's enduring benefits. Right, so capitalization of expenses is key. You have to debate whether it's enduring or whether it's part of production. If it's part of production, it's probably more likely to be part of revenue unless it is enduring. In other words, you're doing something to the tree, the vehicle, whatever it is, and you're having some sort of enduring benefits. Then it's capitalization. Okay, does that make sense? Are you happy with this?
Yes.
Okay. All right, so what system do accountants use when following or preparing statements? Obviously, accountants use the accrual basis of accounting, and tax uses Income Tax Act. Do you agree?
Yes.
Okay, so the one is law or legal. Okay, law, case law, countries, legislation, blah, blah, blah. Okay, all of that law stuff. Okay, the parliament, rules and laws of the country, all of that stuff. Accountants don't use that. Accountants use IFRS. Those are their set of rules. Okay, accountants do things their way. Tax does things a different way. Okay, I think you said to me in a previous session that you're going to do more accounting, FAC. Okay, if you do more accounting, yes, you will learn about something like it's called a deferred tax adjustment. Okay, this deferred tax is only because of this, the differences between SARS and IFRS. That's why you have something called deferred tax. Okay, maybe you've even covered it already, or you haven't covered it yet, but if you do more accounting, you'll get it eventually. Right, so that's what I'm trying to explain here. What system does SARS apply when preparing financial statements? Income Tax Act, rules and laws set by the country, set by SARS. Are the systems the same?
No.
They're not. Okay, so accountants talk about depreciation. SARS talks about wear and tear. Okay, effectively they're the same thing, but they're not, because they use their rules and they use their rules. Okay, different rules are used by different groups of individuals, okay, or parties or professionals. Okay, tax professionals use Income Tax Act. Accountants use IFRS. So what is the deduction?
I say it's an expense.
Yes.
Not really, but yeah.
Okay, a deduction is actually something that you've paid that you want to claim. Does that make sense?
Yes.
Okay, an allowance is not really an expense. An allowance would be like an asset, but a portion of the asset can be claimed. All right, for example, okay, when you buy an asset in accounting, you'll record the asset as a debit, right? And then over the life of the asset, you'll depreciate the asset to reduce the asset's value. Do you agree?
Yes.
Okay, if I'm reducing the asset's value, okay, I'm accounting for an expense, but I'm not paying anyone. Does that make sense?
Okay. Yes.
Okay, an allowance is similar to a deduction because it's a benefit in terms of tax. Okay, those benefits can be deductions or allowances. It makes no difference. Okay, deductions and allowances reduce tax. And that's obviously what you want. Do you agree?
Yes.
Okay, so what contributes to business growth and development? How do businesses grow?
Can I say by investing?
Yes. And investing in what assets? Okay, so if we've got 2 factories instead of 1, are we going to grow? Is there growth?
Yes.
And if I have another one, now I've got 3, is that growth?
Yes.
Okay, obviously if I've got 3 factories, I can employ 3 times as much employees potentially. So does SARS want us to grow? Yes, because if we've got 3 factories, we can be generating 3 times as much revenue as well. Do you agree?
Yes.
Okay, so businesses are incentivized to grow by not only getting maybe more revenue and profit eventually at the end of the day, but they're also incentivized to grow by making use of these benefits, these tax benefits. Okay, because if you go back to the first week, When we hosted this course in the first week, we said we needed to understand the tax system and how tax plays a role in the country. Okay, tax is very important. Everybody has to pay their fair share of tax, because if we don't, there'll be no resources to be used for other things. Okay, so government understands that, and government says, well, for us to increase tax revenue, for us to grow companies, for companies to become bigger, we need to make it how can I say? We need to incentivize them. We need to get them to buy more assets, buy more equipment, buy more computers, buy more machinery, buy more tools, etc., etc. Not only because it's going to help your business, but it's going to give you a tax incentive. Does that make sense?
Yes.
Okay, so what are we looking at here? Not Section 11A. Section 11A is the general deduction formula. We're not looking at that. We're looking at capital allowances, which is this. Right, so when we covered the general deduction formula last week, we spoke about expenditure or losses that would have arose from producing income. See, there's that production of income story again. Okay, repairs is production of income. It's not capital in nature. Okay, improvements, capital in nature. Okay, so if I upgrade the machine, if I extend the factory, okay, those are capital in nature expense line items. They call that capex, capital expenditure. Okay, revenue expenditure is just ongoing production. Okay, operations. Right, so SARS doesn't only allow you to deduct revenue expenditure, they also allow you to deduct capital expenditure, but obviously within reason. Okay, and that's what we're looking at here. So study unit 6 is focusing on this, the capital expenditure. When you have expenses that are not revenue in nature, and then you can possibly claim a capital expense. Okay, so you can't claim twice. Right, so in other words, if you claim something under revenue, you can't claim it under capital. Okay, the reason why I put a block around this is because it's all the other stuff. Okay, other stuff, capital stuff. Right, so deductions are only applicable if they are not capital in nature. Okay, that's a deduction. Right, an allowance is when SARS says this is something additional. Okay, something else that can benefit you. All right, so how can government incentivize the purchase and use of new assets? They can give capital allowance. I can't write anything in. Capital allowances. Okay, all of these items are capital allowances or potential capital allowances. All right, so should we buy more machinery? Of course. Okay, and that can be broken up into movable or immovable assets. Okay, movable would be something that you can pick up and move around. All of these are movable assets. Immovable would be land and buildings. Okay, and machines that have to be installed. Okay, those type of things. Right. The purpose of the assets are very important. You need to look at that. And also, is it new or is it old? Okay, when I say old, I'm talking about secondhand. Okay, remember these assets could be very expensive. Okay, a machine like equipment like this could cost millions. Okay, depending on how big these machines are. Right, so if you've got like a 10 million rand truck, okay, or 10 million rand machine or whatever it is, okay, that machine can obviously be sold secondhand. Okay, because these are expensive assets. Right, and if you sell secondhand, the next person that owns that asset, okay, what's going to incentivize them to buy a secondhand vehicle? Well, there could be capital allowances that they could claim. All right, so businesses, irrespective of ownership, okay, it could be any business, as long as it's a business, right, you do have certain capital allowances that are available to you, but under different categories. All right, so you'll see lots and lots of categories here. Capital allowances are broken up into separate categories. Are you okay so far?
Yes.
Okay. All right, so there's the first category. Category number 1, movable assets. Okay, if I have a movable asset, The first deduction that I can claim is Section 12C, wear and tear allowance on new and used plant and machinery for the process of manufacturing. That's important. Okay, so it must be manufacturing, process of manufacturing. Okay, Section 12C will apply in that scenario. Okay, it's a wear and tear allowance, meaning it's part of the use. Okay, and it's not pro rata. Okay, there's no apportionment. Okay, apportionment means pro rata, so in other words, splitting it. Okay, no one actually looks at that in terms of the splitting of the pro rata. Okay, it doesn't apply, not applicable. Okay, no pro rata. Okay, so what does that mean? That means if you buy a new or used plant or machine, okay, so in other words, machinery or equipment, like big items, okay? If it's new or unused and it's after the 1st of March, okay, you're going to write off 40% in the first year. Okay, so if this machine costs 3 million, okay, 40%, so 1.2 million is going to be claimed as an allowance in the current year, in the first year. Does that make sense?
Yes.
Okay, and obviously that's a benefit, right? Because 40% of a large asset can make a big difference. Right, 20% in the next year, 20% in the next year, 20% in the next year, until the whole thing is written off. Do you see that?
Yes.
Okay, so it's similar to depreciation, but remember depreciation could be working differently. Okay, that's where you get that whole deferred tax thing, but that's definitely not in this module. Okay, deferred tax is actually accounting. Okay, this is just the tax legislation. Right, if it's used any date, you can claim 20% per annum. Okay, got that?
Yes.
Okay, and 20%, but only for 5 years, and for 4 years. Right, so let's assume this asset is old now. The asset is now worth $1 million. Okay, and now I buy it from a farmer or from a construction company. Okay, I buy this machine from a construction company. The machine for them costs 3 million. The machine for me is going to cost $1 million. I can write off $1 million over 5 years. Okay, so I can write off 200,000 every year for the next 5 years, and I would take off 200,000 from what? From my income tax calculation, my taxable income calculation. Does that make sense?
Yes.
Okay, next category. If you're an SBC, it gets even better. Now you don't apply Section 12C, you apply Section 12E. Okay, so if it's new or used, okay, new and used, it doesn't matter. Okay, it makes no difference here. Okay, if you're a small business, if you're an SBC, if it's manufacturing, the whole 100% is deducted when you buy the assets. If it's non-manufacturing, then it's 50, 30, 20. Okay, so if I was a farmer and I bought a 1 million rand used asset, okay, that tractor, okay, that big tractor, okay, that big tractor is going to be deductible. The full 1 million is going to come off. This is going to be an allowance against your taxable income. You're going to minus $1 million. So you pay $1 million, you minus $1 million, but it's due to the nature of the asset. Okay, it's a movable asset. Right, and then you'll show that as a Section 12E deduction. Okay, and you'll see that when you do past paper exam questions, okay, it used to be written, it didn't used to be multiple choice, not online. Okay, so I don't know how they're going to test this. It's going to be interesting to see. But you would have written what the deduction is, and you would have explained what the deduction is. And you would have said SBC deduction, 100% if it's manufacturing. If it's non-manufacturing, 15 year 1, 13 year 2, 20 in year 3. Make sense?
Yes.
Okay, here's a note about SBCs again. Obviously, you want businesses to be classified as an SBC because businesses that are SBCs pay even less tax, because 0% will be payable on taxable income up to 83. Okay, versus a company which would have to pay 28% flat tax. Does that make sense?
Yes.
Okay, so you're going to save money, obviously, as a company, right, if you're classified as an SBC. Right? SBCs don't only have a sliding scale, SBCs also have accelerated wear and tear allowances, especially for manufacturing, because they claim a full 100%, or 50, 30, 20. Make sense?
Yes.
All right, there's the note about movable assets that aren't falling under C and E. Remember I said you can only claim one allowance. Right, so if you've claimed Section C, you can't claim Section E, you can't claim Section 11E. Okay, if you've claimed Section 12E, which is SBC, then you can't claim Section 11E. Okay, what is 11E? 11E is normal wear and tear. Okay, and this is according to SARS. Okay, so this is the SARS interpretation note. Okay, obviously SARS will present a list of assets. Okay, and they'll list everything. Okay, I haven't shown everything. I've just shown a part of the annexure. Okay, obviously SARS will update this list, and there'll be different things on the list. And there's a lot of things on the list. Cell phones, computers, PCs, laptops, air conditioners, whatever, you name it. Okay, if it's not on the list, you've obviously got to contact SARS, and you've got to say, okay, well, I've got a new machine. Okay, question mark. Is it part of manufacturing? Maybe. If it's part of manufacturing, you might get C or E. Okay, if it's not, if you cannot claim it, if you can't claim under those sections, then you can claim under Section 11E. Okay, and then you'll write it off according to a specific time frame. Okay, so air conditioners. Air conditioners will be written off over 6 years if they're window types. If it's mobile, over 5 years. If it's a room unit, over 10 years. Right, so if the air conditioner cost 100,000, okay, divide by 6, divide by 5, or divide by 10, and you would write it off. Okay, writing it off means you would deduct it as an allowance. It'll be a subtraction amount, a minus amount, a negative amount. Does that make sense?
Yes.
Okay. All right, what happens with all those other assets? So now we also have land and buildings. Okay, so notice SARS is really wanting to incentivize growth and development. Okay, immovable assets, even land and buildings, will be able to make use of these deductions. Okay, these allowances. Okay, these allowances are small. Okay, 5%. That means you're going to be writing off an asset over 20 years. Okay, buildings normally last long. So if you have a building, Section 13(1), okay, this is where it comes from in terms of the Income Tax Act. Okay, the building, if it's a building only, okay, and if it's used for manufacturing, and if it's after 1989, which in most cases it is. But remember, you could have buildings that are older than that. All right, but if this applies, every year you can claim 5%. All right, Section 13 Quin, if it's commercial, right, so that would be like office space. Right, commercial buildings, also 5%, not apportioned. It must be for the purposes of a trade though, okay, and it must be for production of income. Right, this is post-April 2017. Right, if there's no building, but you've purchased it, okay, 55% adjustment if it's only part purchased, or 30% if it's an improvement. Okay, it's very, very, very specific. Okay, we can look at an example in the study guide. Okay, you'll see one or two. Okay, it's just something that they have to provide, because remember, SARS wants you to benefit. So if there's no building, there could still possibly be a deduction, but again, you have to adjust. All right, so 55% adjustment if only a part is purchased, or 30% if it's an improvement. Okay, so in other words, you can't claim all, you claim a portion, okay, because there's no building. All right, then you've got section 13.6, which is looking at residential units. Right, so also 5% deduction, okay, post 2008. Right, the reason why these dates are quite recent is because capital gains tax, CGT. Next week we'll be looking at the last study unit 7. Okay, you'll see CGT was only created a few years ago. Okay, 2001 I think it was. Okay, we'll check it in next week's notes. Right, CGT is actually quite new, and this is a lot of new legislation that affects capital allowances. Right, and that's why if you look at the 2000s, 2001 onwards, 2008 onwards, okay, there's a lot of new development in South Africa. Okay, the reason why government created all of these additional capital allowances is to encourage growth and development. Okay, and that's why if you look around the country now, okay, you're also in Johannesburg. Okay, you're also in Gauteng. Okay, Gauteng now in 2021 compared to 2008, there's such a big difference. There's more residential units all over the place because companies get to claim deductions. I mean, if a residential unit costs R1 billion or more, even if it costs R1 billion to create, to construct, okay, 5% of R1 billion is a lot. Okay, this is R1 billion. Okay, what is 5% of R1 billion? Let's check. It's 50 million. Okay, which construction companies isn't going to mind taking off 50 million from their tax? That's huge. Okay, that's a huge incentive. And that's why businesses, even corporates, why do you think corporates have built new offices? Okay, and there's a lot of new buildings around. Maybe you've seen them around. Okay, it's all got to do with government. Okay, the legislation that government has passed in the past helps the present. Okay, that's why businesses like building, businesses like developing, businesses like buying new property, because when they do that, they're claiming 5% of that amount. And we're looking at big numbers here. Okay, I mean, 5% of R1 billion is 50 million. Right, that means you're going to claim 50 million as an allowance for the next 20 years. Which company wouldn't want to do that? Okay, does that make sense?
Yes.
Okay, that's why property companies do so well, because property companies are incentivized not only to build, but they're incentivized to keep building and to keep developing. That's why you'll see more and more developments for the next few years as well, until maybe it gets saturated. Or unless government maybe adjusts or changes the rules slightly. Okay, but 5% is very, it's small, but it's very big in terms of an allowance for a construction company or a business. Okay, other things to look at, other sections of the Income Tax Act. If you go to section 13 sept, low cost residential units, so those cheap houses. Okay, even if you loan money to build cheap houses, as long as it's post 2008, you are going to get a certain amount as a deduction. Okay, 10% of the amount owing. Right, so not only do you benefit in terms of constructing low cost housing, but there's also an incentive to do so. Because you get deductions, you get capital allowances. Okay, remember allowances? We spoke about the basic deduction formula, section 11A. Capital was clearly omitted. Okay, it's omitted because capital allowances are covered separately. Right, and then you've got urban development zones. Okay, refurbishments. Right, section 13 quat. Okay, 13 quat looks at refurbishments, and you can claim up to 20%, okay, 20% per annum, or depending on whether it's new or extensions, it could be 20% in the first year and then 8% for the next 10 years. Okay, it all depends. All right, so urban development zones. Okay, so when you have certain areas that have been zoned for development, okay, especially for people. Okay, obviously the government wants everyone to have a roof over their head, right? Most people don't. I'm sure you've probably seen lots of informal settlements and things like that. That's obviously not ideal. So government obviously wants to get to a stage where every single person has something, has a house, has a roof over their head. And the only way they can incentivize companies, okay, because remember, government can't do all of that on their own. So government tries to incentivize the private sector, businesses, to do the same thing. So if businesses build low-cost housing, or if businesses develop certain areas, government is going to incentivize them to do so. Right? And that's why there's lots of development all around the country, because it makes business sense to do it, because not only does the company benefit, because the company gets to claim all of these capital allowances, but these companies can also claim all the ongoing. Because remember, don't forget the revenue, hey? The ongoing operational expenses, right? All of that can still be deducted, but as revenue, not as capital. Okay, does that make sense? Are you okay with that? Are you following?
Yes.
Perfect. Okay, then just the last bit is just look at the differences between accounting and tax. Okay, I spoke about this earlier, and the reason why I'm showing you it is because of this recoupment and scrapping allowance. Okay, this comes up in accounting as well, but you probably haven't covered it yet. Okay, maybe later on when you do more accounting, but it has relevance from a tax perspective. Right, so when you look at accounting, how do you work out carrying value? Carrying value is the cost minus the accumulated depreciation. Do you agree?
Yes.
Okay, depreciation, we said, is a write-off of a company's asset over time because the asset loses value. Do you agree?
Yes.
Okay, SARS does the same thing, but SARS does it according to capital allowances because SARS will use the Income Tax Act. They're not going to use your depreciation method, diminishing balance or straight line. SARS doesn't use that. SARS uses the legislation. They use the law. Okay, so SARS will have the cost of the asset. They'll have the capital allowances, so that could be Section 12C, Section 12E, or Section 11E. There could be others as well, okay? Maybe the Section 13 allowances, okay, the immovable property. Okay, but the point is, when you're dealing with assets, okay, that's what we started with at the beginning of this set of notes. Okay, your assets are important. Your assets determine the wealth, the value in the company. Okay, so if the company can continue to build its assets, to either construct more buildings or to buy more buildings, right? And if they do so, they can get certain allowances as well. Okay, so if I'm looking at the tax benefits of property, I can have a profit or I can have a loss depending on what happens. So when I sell those assets, if I sell the asset and it's greater than the carrying value, there'll be a profit. Okay, in accounting, this was added to the income statement. Do you remember that? The profit or loss on sale is included in the income statement. Do you agree?
Yes.
Okay, the same will apply from a tax perspective. So when you have a taxable income calculation, okay, remember we have gross income at the top, then allowances and deductions, and then we add capital gains. Okay, a recoupment or a scrapping allowance. A recoupment is a special inclusion. A scrapping allowance is a special deduction. Okay, those special inclusions or special deductions are either added to or taken out of your tax calculation to work out your taxable income. Okay, so a recoupment will always be included as part of gross income. If you go back to the notes, when we covered gross income, you would have seen recoupments on one of the pages. Okay, something that we specifically have to include. Okay, and then when we covered scrapping allowances or special allowances, okay, our closed study unit 6, not 6, 5. I see I don't have it open here. I'm just looking at my open documents. But if you look at last week's content, a scrapping allowance is a special deduction. Right, but just remember, a recoupment is only limited to the previous allowances. So SARS will only include a profit up until the previous allowances. In other words, let me just put it this way. They're basically taking back those allowances that they've given you. Okay, because over the life of the asset, you've been claiming allowances. So if you make a profit on the sale, okay, the recoupment will be limited to those previous allowances. Right, and they do that just to make sure that they're not being unfair. Okay, because whatever's above the recoupment amount will be a taxable capital gain. Okay, that's the next section. That's study unit 7. Right, so when looking at a recoupment, the recoupment will only be up until the amount of the capital allowances. Okay, any amount over and on top of that will be a capital gain. Okay, because now you're selling an asset at more than its tax value or carrying value. Okay, right, you'll see some examples in the notes, and you'll see lots of examples in past papers. Okay, this is quite a common thing. You'll see recoupments and allowances. Just keep it simple. When I talk about this in practical questions, you'll see I'll make the distinction between accounting and SARS. SARS uses allowances to represent depreciation, and SARS uses tax value to represent carrying value. Is that all right?
Yes.
Okay, so just remember, a recoupment is almost like a recovery of the claimed allowances. You're going to include that in your taxable income. It'll add to your taxable income. It'll make your taxable income bigger, not smaller. A scrapping allowance will reduce your taxable income. Okay, so scrapping allowances are good from a tax perspective because you end up paying less tax. Okay, but that's when you sell goods or assets at a loss. Okay, so selling things at a loss isn't always a bad thing. Sometimes selling things at a loss can generate something positive in the form of a scrapping allowance. Okay, so sometimes businesses are desperate and they can make use of these inverted commas losses, but from a tax perspective, that actually turns out to be a inverted commas a gain. But a gain not from a monetary point of view, but a gain from a tax point of view. Okay, you'll end up paying less taxes rather than more taxes. Okay, there is a little note here just regarding accounting versus SARS. When you're looking at disposal, okay, if the disposal proceeds of a building is used to buy another building, so in other words, you sell one building, X, to buy another building, Y, okay, there could be a potential deferral of the recoupment. In other words, the profit on the one building, okay, being deferred to the other building, right, because you've bought the building. But it's a very, very, very unique scenario, and it doesn't always apply. It only applies when you buy one building to be used for another building, okay, and the new building must be purchased or built within 12 months from the disposal dates. Okay, so it's just a way to how can I put it? To make it easier for the taxpayer. Okay, because the taxpayer could potentially pay lots of tax if the recoupment is quite high. Okay, in other words, the profit on the sale. Okay, if the recoupament's quite high, it's going to increase their gross income, okay, or their taxable income, and that's going to make it more difficult for those businesses to operate because now they've got this huge tax burden because of a massive recoupment. Okay, so if you're buying one building for another one, it's obviously going to affect you a bit differently. Okay. All right, and then the last bit, just to summarize the content, the summary for this week. This diagram is actually quite useful because you'll see when I do exam questions, I refer to my notes and I just ask the question, is it immovable or movable? If it's movable, then I can possibly claim Section 12C, Section 12E, or Section 11E. Okay, manufacturing or not, if it's manufacturing, then I need to apply certain allowances. Okay, if it's an SBC, then I also apply certain allowances. Right, apportioned or not, meaning do I prorata it or can I claim the full amount? Right, so you have to look out for these 4 scenarios. Okay, when you're doing any question that relates to assets, any question that relates to assets, any question, you need to always think about capital allowances, and you need to ask the question: movable, immovable, manufacturing or not, SBC or not, a portion or not, and then you'll get the answer. Okay, then you'll know what to apply. Okay, and that you'll see in different examples. Okay, is that all right, Cheryl?
Yes.
Okay. Because of time, I'm going to ask you just to have a look at the study guide. We can start next week with the study guide. I'll go through the study guide and we can see what they've included here in study unit 6. But I'm going to ask you maybe just to go through and read through the content, the important bits and pieces, and then see if you can try do some of those exercises to see if you can apply some of those deductions in context. So, okay, where is it? Here. There, learning unit 6. Okay, you'll see they've covered different topics under each section. Okay, so next week, what I can do at the beginning, we can go through all of this. We can look at it in the actual study guide, and then we can address any questions you might have. And then we can even look at a few examples if you want to. But it's all about a deduction. What can I deduct? How much can I deduct? Right? It's all in line with the percentages. Okay, the notes. Is that all right?
Okay. Yes.
Okay, perfect. Right, to see how that goes, we can address it next week, and we can see how much of it you want me to just elaborate on or go through in more detail. We could even look at some of the examples even, okay, before the actual self-assessment questions. Okay, the self-assessment questions are better because they're exam type questions. And that's why it's nice to do those. Okay, but we will get to exams eventually later on. We'll obviously do those a bit later on in the year because you did say that the exam's postponed and you prefer doing it closer to the exam rather than earlier. Yeah, but it's up to you. We can plan that as we go. Okay. All right. Happy?
Okay. Yes.
Okay, perfect.